Two people, same age, same job, same $90,000 sitting in the bank. 20 years later, one of them is holding $618,000 in home equity. The other is holding $671,000 in an investment account. They made the opposite decision, and the gap between them is far smaller than the internet has been screaming at you. That is the part nobody actually runs. You have been told that rent is throwing money away. You have also been told that buying a home at today's rates is financial suicide. Both of those sentences are marketing. Neither one is math. So here is the math. Two names, one variable, a 20-year ledger. And no verdict handed to you at the end, because the verdict depends on something inside your own life. Meet Marcus. He buys. Meet Dana. She rents. They both start with $90,000, and they both earn exactly the same paycheck. Everything else in their lives is identical. Only the housing decision changes. Marcus buys a $400,000 home. That is roughly the national median right now. He puts 20% down, which is $80,000, and he spends the last $10,000 on closing costs. His savings account is now empty. He borrows $320,000 at 6.5%. His monthly principal and interest comes to about $2,023. But that is not his housing cost, and this is where most people lie to themselves. Add property tax, around $300 a month. Add homeowner's insurance, around $150. Add maintenance, and the standard estimate is 1% of the home's value every year, which is another $330 a month. Marcus's real housing cost is roughly $2,800 a month. Dana rents a comparable place for $1,850. She still has her $90,000, and she invests all of it in a plain index fund. Then she takes the $950 monthly difference between her rent and Marcus's true cost, and she invests that too. Every single month. No exceptions. Hold that word. Discipline. It is going to decide this entire duel. Year one arrives, and Marcus gets a surprise. He has been paying about $24,000 into that house. But look at what he actually owns. In the early years of a 30-year mortgage, roughly 3/4 of every payment goes to interest, not principal. Marcus paid over $20,000 in mortgage interest that first year and added only about $5,500 in equity. He did not build wealth. He rented money from a bank. And appreciation did not rescue him either. The S&P CoreLogic Case-Shiller National Index posted a gain of just 1.3% for the full year of 2025, the weakest calendar year since 2011. The era of the house that gains 10% a year while you sleep is not the era you are buying into. Meanwhile, Dana's $90,000 is compounding quietly at 7%, which is roughly the long-run average of the U.S. stock market. Nobody sends her a maintenance bill. Nobody replaces a water heater. At year 5, Dana is ahead. Comfortably ahead. So renting wins, right? Wait. Because now the second force enters the ledger, and it is the one renters chronically underestimate. Marcus's mortgage payment does not move. It is $2,023 in year 1, and it is $2,023 in year 19. Frozen, locked. Dana's rent does move. If her rent climbs 3% a year, which is conservative historically, then her $1,850 apartment costs $2,485 by year 10. Watch what that does to her strategy. Her $950 surplus shrinks every single year. Around year 11, it disappears completely. There is nothing left to invest because rent has eaten the entire gap. That is the quiet violence of a rising rent. It does not just take your money, it takes your ability to invest. So let's close the ledger at year 20. Marcus's home, growing at a modest 3.5% a year, is worth about $796,000. He still owes roughly $178,000 on the mortgage. His equity is about $618,000. If he sells, agent fees and closing costs take about 6%. So he walks away with roughly $570,000. Dana's $90,000 grew into about $348,000. The 11 years of monthly investing grew into about $323,000. Her account holds roughly $671,000. Cash out, pay long-term capital gains, and she keeps somewhere near $602,000. $570,000. $602,000. 20 years, two opposite lives, and the difference between them is about 5%. That is a rounding error dressed up as a culture war. But look closer at the ledger, because there are two things it does not show you. The first thing is that Marcus's payments stop. In year 30, his mortgage ends and his housing cost collapses to taxes and upkeep. Dana pays rent for the rest of her life, and that rent keeps climbing after the ledger closes. The second thing is bigger, and it is the real answer to this video. Dana only wins if Dana actually invests. Every rent versus buy calculator on the internet quietly assumes that the renter invests the difference with the discipline of a machine. In real life, that money goes to a nicer car, a weekend in Miami, a slightly better apartment. The Federal Reserve's Survey of Consumer Finances shows the median net worth of an American homeowner at around $396,000, against roughly $10,400 for renters. 40-1. That number is not proof that houses are magic. It is proof that mortgages are a savings plan you cannot quit. A mortgage is a bill. Investing is a choice. And humans keep bills and skip choices. So the variable in this duel was never the house, it was the person. Which means you now need one number and one honest sentence. The number is your price-to-rent ratio. Take the price of a home you would actually buy. Divide it by 12 months of rent on a place you would actually live in. Under 16, buying is compelling. Over 21, renting is compelling. In between, it is a coin flip decided by your life, not your spreadsheet. This is not a national question. In San Jose, that ratio is above 45, and buying is close to indefensible on cash flow. In Detroit, it sits around 8, and renting is the expensive mistake. The same argument that is correct in Michigan is nonsense in California. Then run the second gate. How long are you staying? Buying and selling costs you somewhere between 8 and 11% of the home's value in transaction fees, round trip. Under 5 years, you almost certainly cannot earn that back. Over 7 to 10 years, the ledger starts tilting toward the owner in most markets. And then the honest sentence. Say it out loud, alone, where nobody can hear you. If I rent, will I really invest the difference? If the answer is yes, and you can prove it with a bank statement, then renting in a high-ratio city and buying index funds is a legitimate wealth strategy, and you should stop apologizing for it. If the answer is no, and for most people it is no, then a mortgage may be the only thing that ever forces you to build equity, and that is not a failure. That is self-knowledge, and self-knowledge is worth more than a spreadsheet. Here is what you can do today, and it takes 10 minutes. Open the listing site. Find the price of a home you would buy. Find the rent on a place you would live. Divide. Write the number down. Then look at your investment account and ask whether last year's version of you actually contributed anything to it. You now have the two numbers that decide this. Almost nobody in that comment section has both. Two people. Same age, same job, same $90,000. The one who ended up wealthier was not the buyer and was not the renter. It was the one who knew which kind of person they were before the money was on the line. Subscribe for calm, no-hype money breakdowns every week.